You think Medicare is free once you turn 65? Well, not quite. There's this hidden surcharge that can quietly shrink your Social Security check by thousands a year. It's called IRMAA. You might have heard of it, but most people don't even see it coming. So today, this video will break down who's impacted and how you can avoid it. Welcome in. Glad to have you on the show once more. I'm Ben George with Ryan Ledden of Black Oak Asset Management. Ryan, looking good in the camo today.
Yeah, sporting it. This is getting that time of year. I used to go all the time. We used to go on like elk hunts out in Colorado and deer hunting in South Georgia. Then, my son's football season just gets in the way of that. But yeah, sporting a little camo. Buddy of mine's company. Is an outfitters company, and they do a lot of kind of outdoor apparel, but also kind of for business casual days. And so, yeah, I'm not like most advisors where I got, nice coat and tie and all that kind of stuff on. No, I am who I am. So, but yeah, he started this company, and I noticed it at football practice one day because I coach football with him. I'm like, where? Like, that's a really cool top. Where'd you get that? And he's like, oh, it's my clothing company. I'm like, wait, what? Like, you have a clothing company? Like, when is it? So anyway, it's just starting, and I even did a few, I hate to say modeling shots. It's not modeling, but I did have his apparel on. So it's on Instagram of pictures of me. So it's kind of strange and weird, but I said, hey man, I'll wear your gear on camera one day. So give you a little plug.
Don't downplay it, man. You're showing up on my Instagram feed under sponsored ads now. Seeing your shot, your mug everywhere, but love it. Well, good stuff. Let's jump into today's topic because I know Medicare obviously is a big topic for retirees. It's a huge part of the puzzle as you're kind of putting things together. But there's this thing called IRMAA that I think a lot of people just aren't prepared for, don't see it coming. So I want to kind of get in that today with you a little bit and just start off with what it is, because I think you probably heard IRMAA. You might not know what it means, what it stands for, but what is it? Why does it actually exist?
Yeah, and you're going to see me look down because I got some show notes here because there's so much specificity to Medicare and numbers, and I got another screen up here where I make sure I got all the premiums right because it's hard to kind of put this stuff to memory. And I know Medicare stuff is not like super exciting, but it's important. We're all going to use it one day, but then how do we kind of cut the cost of what we actually need? So, but yeah, IRMAA, I've always just said IRMAA when we talk to our clients, but it's income related monthly adjustment amount. So what that is, it's essentially it's based off your modified adjusted gross income. So there's another acronym. So MAGI, MAGI. So essentially modified adjusted gross income is taking your AGI, adjusted gross income, that's on your 1040 on line 11, I believe. Then you take that number and you add it to your tax exempt interest, which is basically line 2A. So tax exempt interest, that's going to be, a lot of your municipal bonds, whether that's state or local municipal bonds. So we always hear that some of those are tax free, depending on the issuer and where you live, but it does factor into calculation. So that tax exempt interest isn't technically tax-free because it could add to your premiums when it comes to Medicare. So what it does is, it applies to your Medicare B and D. Now, we're not going to get into the alphabet soup of what each one is, but there's A, there's B, there's D. I mean, there's a whole laundry list of letters that go in there, but we're applying to how much extra your premiums may cost based off of your IRMAA. So if your income is high, then you may pay extra premiums. And people are like, well, wait, what? I pay for Medicare in retirement too? Yeah, you do. A lot of times the premiums just come out of your Social Security check on a monthly basis. So how they do the calculation, it's a 2-year look back. So if let's say you're retiring this year, they look at your 2023 income, and it's just always a 2-year look back. And that's what these numbers and premiums that we'll get into in this discussion, that's what those numbers are based on. So the higher your taxable income, the higher your premiums potentially could be.
All right. Good to know. Good kind of background on what IRMAA is. So I know people were wondering, okay, well, am I at risk? Is this going to impact me? So we're going to throw up a graphic. If you're watching us on YouTube, you'll see it here. If you're listening to us, make sure you check out the YouTube channel. You can see this graphic for yourself. You can kind of follow along, but kind of break it down for us, Ryan. Who's most at risk here?
Yeah. So again, looking at the numbers here on my show notes here. So again, single filers, if your modified adjusted gross income is over $106,000, then you could have, or you will have, higher premiums than married filing jointly. If your modified adjusted gross income is over 212,000, when you start paying into Medicare. So, and some people are like 212,000. I'm not going to need that much money in retirement. It's amazing how quickly you can get to that point, especially if you're, it's a married filing jointly. So if you have two good income earners throughout your working life, and then you have two good Social Security checks that are coming in, and maybe you do have a small pension, maybe you don't, but then you've saved really, really well over the course of your working life, and you have large retirement accounts. All these things start to add up, and before you know it, you may get to that threshold where you're at 212,000 married filing jointly, or 106,000 as a single filer. So I'm looking at my chart over here, and so your premiums, if you're below those amount, are $185 a month. So if you jump over those dollar amounts, then it increases and it goes up by essentially $74 a month. And we'll get into more of the math here in a second, but you start getting these increments and they start getting higher and higher. Before you know it, your monthly premiums, again, which get taken out of your Social Security check, continue to get higher and higher and higher. So again, dual income professionals, business owners like myself, maybe you sell a company and then boom, you're way into a higher tax bracket, and all of a sudden your premiums for the year are really expensive. And then when you do Roth conversions, Roth conversions add to your taxable income. So we want to be cognizant of, we're not throwing you too high in a tax bracket, because then that affects your Medicare premiums. We inherited a client from someone else that another advisor suggested that they do a Roth conversion, which I love Roth conversions, but they didn't pinpoint a number. They just said, hey, do this much. And it threw her over that $106,000. And all of a sudden her Medicare premiums are higher for a year. So it's just, you got to be aware of those things. And that's some of the things that we walk through and make sure we try to stay underneath that threshold if we can.
Yeah. And this chart shows you why it's such a big deal, right? Because I mean, it's great if you're not paying anything extra, but it doesn't take a lot on those, on the income scale to really bump it up to be a significant amount of difference and additional payments you're making every month. And that can be a big bill at the end of the year.
Yeah, because once you get over those thresholds that we just mentioned, 106,000 for a single filer and the 212 for married filing jointly, then after that, you spill over into the next one a whole lot quicker than you do. So it's not like it's kind of like a marginal tax rate, where the more you make, you kind of spill over into new tax brackets. Well, this isn't a tax. This is just an extra cost, if you will, that they're slapping on you for people who are higher income earners. So you're having to pay more of your fair share is kind of the definition that they talk about. So yeah, it's easier to jump into that. And then that's just the numbers I just mentioned was just part B. Then you have part D, which is your prescription drug. So that can continue to go up as well. So not only are you paying higher for B, then you're paying higher premiums for part D. So just being aware of where you're at can really save you, especially on a fixed income. If you're in retirement, you're kind of on a fixed income, if you will, because you have no paycheck coming in. Your paycheck is coming from your Social Security, your investments, pensions, et cetera.
Yeah, I mean, just doing the math there, you could see if you are on the highest end of that, you're talking about up to over $6,000 a year in costs that you might not have been prepared for. So something to pay attention to. Let's talk a little bit about some strategies here and just some things to be aware of in order to avoid triggering IRMAA. I know you talked about some of the things that do, but just talk about kind of what does trigger IRMAA and what doesn't.
Yeah, some of the triggers, again, that adding to that, first AGI, adjusted gross income, and then the tax exempt interest. So your RMDs, so your required minimum distributions, which I know, Medicare starts at 65 and your required minimum distributions don't really start till 73. And for some, it'll eventually be 75, depending on what year you were born in. I get those aren't like happening at the exact same time. but eventually require minimum distributions on pre-tax accounts that you have not taken money out of. You'll have to eventually take those out. Any capital gains on your non-qualified or your brokerage account investments, those count as well. Even selling real estate, those are capital gains. A lot of people that we work with have stock options. Okay, that's going to add to it because you have to pay some tax on that. Again, business owners, if you're selling a company, again, I mentioned tax exempt interest on bonds. Again, we think we receive that income tax free from a taxation standpoint, but it adds to the calculation for increased potential premiums on your Medicare. Pensions, again, that's we work with a lot of pension employees. So that's ordinary income. So that's going to add to it. So all those things start adding together. And like I said, on your 1040, it's on a line. It's on line 11 for your AGI, and then you add 2A as well, which is your tax exempt interest, which gets you to that modified adjusted gross income, which all these premiums that the chart shows is based on.
And there are a few things you don't have to be worried about, right? Triggering that IRMAA.
Yeah. So here's where we talk about. I mean, we beat Roth IRAs or Roth 401ks. We just keep beating that drum, but it's so true because Roth IRAs or Roth 401ks, it's income to you, but it is not taxable income to you. It doesn't trigger these calculations. It's just a flow through, and it flows all the way down. And if it's Roth, those don't count toward this calculation. Any HSA distributions, again, because that's the triple tax benefit of putting it in pre-tax, having it grow tax deferred, and if you take it out for medical expenses, it's tax free. No other investment vehicle is out there like that does that. You could even put like loans that come out of any like cash value life insurance. That's not technically taxable income as well. And then sometimes people do reverse mortgages because that could be as income as you, and that doesn't factor into the calculation either.
Okay, some things to be aware of there. So then what are some strategies then for people that are concerned about this? What are some ways to maybe lower those extra additional payments or maybe even eliminate it altogether?
Yeah, one of the biggest ones is Roth conversions. Again, talk about that all the time, but Roth conversions a little bit over time will still ease that obligation of when you do have required minimum distributions because you have no wiggle room on an RMD. It is a factual calculation based off of how much you have at the end of the year and your age. That's how much you have to take out. If not, you pay a penalty. So then you have to take out even more. So Roth conversions are huge. QCDs, we've talked about those on here before. You can give pre-tax dollars to a 501c3 or a charity, and that counts as your RMD. So you're not paying tax on it. It counts as your RMD, and the nonprofit gets your money that probably has a meaningful place in your heart for it. So QCDs, please do those. That is just the biggest avenue that I think a lot of people are missing when it comes to taxes. So those are the big two. I mean, there's others that are out there, but I love Roth conversions and then QCDs, qualified charitable distribution. Those are two great avenues to take to avoid maybe some of these higher premiums that you're going to have to pay on Medicare.
Yeah, and this is really one of those great examples of why you do planning, right? Why you sit down with a professional like yourself, Ryan, you're a certified financial planner, and kind of go through these things. Because if you're trying to do this on your own and just not aware of these additional payments, it's going to cost you, right? It's going to eat into what you saved. But by doing some work now, by doing some planning now, you can avoid these altogether, definitely reduce them by making some smart decisions now. So again, if you want to talk with Ryan, speakwithryan.com. Go there. You can schedule a time to meet with him, the team there at Black Oak Asset Management. We're talking about your future. We're talking about your finances and where you need to be heading and the adjustments to be made. And again, of course, some things you can be doing to avoid Medicare and this IRMAA, because it can eat into it quite a bit, as we've seen today.
Yeah, just a few $100s a month makes an impact. So you may think you know what your Social Security benefit is going to be on a monthly basis, and all of a sudden you actually receive that check or the direct deposit from Social Security, and you're like, wait a minute, that doesn't look right. Maybe taxes ate into it, and maybe higher premiums that you weren't ready for. So the tax planning software that we use and the income planning software that we use factors those two things in. And it shows you how much wiggle room you have before you start spilling over into those higher potential premiums that you could be paying in Medicare.
Awesome. Very good. Well, again, go to speakwithryan.com to get on this calendar, but we appreciate you watching. Hopefully this helped you out. If you have any questions, please don't hesitate to follow up.